Back in 2012, many analysts were concerned that Canada's red-hot housing market was a bubble waiting to pop. But since Ottawa tightened mortgage lending rules a year ago, almost 10% of potential home buyers may have been prevented from entering the market. And between May and June, Canadian home prices increased by a mere 1%, the smallest increase in more than 3 years. Phil Soper is president and CEO of Royal LePage. Thanks for coming in.
My pleasure.
Your view, sir, on where the Canadian housing market is in terms of a soft landing or another leg to come, or we're done?
Well, from a consumer standpoint, people are very focused on home prices. I think we'll see very soft home prices, but still increases, very small increases in most parts of the country. From an industry standpoint, I think we'll see increasingly improved results in terms of the number of homes trading hands in the third and fourth quarter versus the last 4 or 5 quarters.
So prices will drop, you'll sell more homes?
Prices will rise,
sort of more slowly,
but
right.
The long-term average is about 5%. And we've been tracking it about, well, between 1 and 3, so well below the long-term average.
Are we, I mean, is there a difference in your mind between the housing market and the condo market? I mean, that's something that a lot of people are talking about.
Really depends on the city. The overall housing market in Toronto has 2 extremes. Toronto proper, the detached housing market is severely supply constrained, and we actually have unusually high price increases given the strength of the overall market. The condominium market, on the other hand, had a lot of projects come on board right after the 08-09 recession. It takes 2 or 3 years to get those big projects into market, so we have an oversupply on that side. The rest of the country, there's much more balance.
One of the pieces of data that came out recently is that 1 in 10 Canadian households have borrowings in excess of 250% of gross income, which is much too high. Does that not spell future trouble for the housing market?
Revolving debt, consumer debt has actually been decreasing. So the message from policymakers, whether it be the central bank or the Department of Finance, I believe has been getting through. What has been increasing is real estate secured debt. So if you believe that the housing stock in Canada will retain its value, then it's not a big concern. If you believe, like some did, that there was going to be a substantial reset in the value of our houses, then it would be a really substantial value. I'm in the first camp. I believe this correction will be predominantly driven by lower than normal house price increases. I know, you know, it's small increases when typically, you know, restricted commodity like housing inches up in that mid-single digits rate.
I mean, housing is such an important topic for lots of Canadians, and everyone kind of hangs on every single word and string. What about mortgage rates? I mean, you know, mortgages are such an impactful component of this equation of home ownership. You know, we've seen some of the banks increasing their back end of the mortgage rates. What are your thoughts on where mortgage rates are going over the next couple of years, and or not even years, but next couple of weeks and months and quarters?
Very, very hard to predict, but in general, I don't see any of the elements that would lead to a sharp increase in mortgage rates on the horizon, call it through the spring market of 2014. So the spring market's the all-important market in North America. It's when most of the homes in a country are sold. And I believe we'll be looking at, again, very, very low interest rates for that period. And with continued problems in Europe, the debt levels in the United States, concerns about the Canadian dollar rising at too rapid a rate, all of those point to pretty low costs of money in the medium term.
We've got to leave it there, Phil. Thank you so much.
Okay.